Hi there, welcome to Kneppy Invest. Today I am going to react to a Motley Fool article. This is something I've been thinking about doing for a while, reacting to articles, whether they be from Motley Fool, Livewire, Morningstar, whatever. And one of the reasons I want to do this is because a lot of these articles do provide us with ideas. And I have had that question before. Where do you get ideas from? Now, I get the vast majority of my ideas just from announcements from companies. We see announcements released every single day. And over time, I build up a bit of knowledge about companies just from their announcements, whether they be financial reports, trading updates, contract wins, contract losses, whatever it is. Presentations, I do like to look at presentations, and that is my primary way of getting ideas. But we do have a plethora of sites out there that do provide articles, and Motley Fool is one of those sites. In fact, Motley Fool is prodigious when it comes to articles. I just had a look at their website. For instance, here it is. I actually haven't closed it down. Just today, it's just article after article after article. And I think this is just one of their sections. Yeah, latest news articles, Australia share market news and commentary. They seem to have a lot of different areas, but yeah, just article after article after article, talking about why company share prices are dropping, why copper shares seeing gold today. These 4 ASX 200 stocks are leaping higher this week. Own any. So I thought, why not have a look and react to a few of these articles? Why not do that? And I did find one that is really interesting. This one is written from or by James Mickleborough. 3 super ASX 200 stocks to buy after this market sell-off. Now, this is not James Mickleburgh's opinion. This is actually from Wilson's Asset Management. And I have noticed this as well. Motley Fool does this. They'll write an article and just showcasing recommendations from brokers. So this isn't Motley Fool recommending these 3 companies or James Mickleborough. This is Wilson's just saying the recent pullback has made these companies attractive. And the 3 companies are Car Group, Siteminder, and Xero. I do own Xero. I wouldn't mind owning Car Group. I do not own Siteminder just yet. And there's a few reasons behind that. I would not consider that company to be high quality. I probably would consider Xero to be on the cusp of being high quality, and Car Group definitely high quality. So let's have a look to see why these 3 companies, these 3 super ASX 200 stocks, not sure how they determine what is super about these 3 companies, because Siteminder is not profitable. And that is the difficulty with Siteminder. But let's see why Wilsons believe these 3 companies are a buy. I am going to focus on one, that is Car Group. So I'll quickly go through the other 2. Now, Xero, they talk about that, in fact, in this article, they do have a fairly long quote, but Wilson's just like the company due to its potential to continue with earnings upgrades, which is interesting. I think this company, which did hit that inflection point of becoming profitable not that long ago, it was the active decision from the company. Instead of seeking revenue growth at the expense of profitability, they decided we really need to show the market that we can be profitable. And they did that, was it last year or year and a half ago? And the share price or the chart for Xero has been really good for a while. So let's have a look at the chart for Xero. Yeah, share price has pulled back. In fact, there has been a moving average crossover, by the way. But this is, for me, this is more of a long-term hold just because of that potential. Exactly what Wilsons are saying. If you have a look at some of the, say, metrics, financial metrics, price earnings ratio is 122.9. So you're not going to buy this just based off the P/E ratio. And there is potential that the profit of this company could increase 3 or 4-fold over the next few years. So definitely, P/E ratio of this company is not something you should be looking at, just my opinion. For instance, In the past year, this company only had profit of 162 million after being unprofitable the previous year. So they went from having a loss of 103 million to having a profit of 162 million. So who knows what's going to happen in the next year? They could double their profit, which would make a P ratio of 122 much lower. Anyway, so chart looks okay for Xero. So no complaints about that one. Well, and to be fair, I'm not going to complain about any of these companies. Siteminder is an interesting one. This one, Siteminder is not profitable, and I do find trying to figure out a valuation of an unprofitable company to be quite hard. Don't even think they are operating cash flow positive. I could be wrong. Maybe not wrong, but I could be wrong. I'm just going to see if Siteminder is at least operating cash flow positive. So that is probably the first inflection point I am looking for. Definitely not profitable. In fact, I've lost in the last half year of almost 14 million. But are they close to being operating cash flow positive, which is really the first thing I'm looking for. So we have to go to the cash flow statement. And they are. They are slightly operating cash flow positive by 5.8 million. However, they did spend $11.7 million on payments for intangibles, which is an ongoing cost. That's sort of like capitalized research and development. So in my opinion, even though they are operating cash flow positive, they're free cash flow negative by a fair bit, by $6 million. So they haven't really reached that inflection point that I'm looking for. Nice revenue, by the way, a revenue of 104 million. So you might be asking, how can you not be profitable with revenue of $104 million? Well, they do spend $58 million just on employees, $25 million on direct transaction costs, and $13 million on depreciation amortization expense. That would be amortization, which is sort of like depreciation for intangibles. So we go back to the cash flow statement. They spend a lot on intangibles, which is research and development, and that is amortization, $13.4 million just in that expense. So that's why they're not profitable just yet. But if they keep growing their revenue and they do find some leverage, this company could be becoming profitable quite quickly, sort of like Xero, and then they really could increase their profit at a fairly quick rate if they do hit that inflection point. So if we go back to this article, it says another ASX 200 stock that could be cheap. Interesting wording there. Could be cheap. Yeah, it could be really expensive too. Wilson believes that its shares have been oversold. That's more of a technical thing, not really company related, which has created a compelling buying opportunity, especially given how it feels there are upside risks to medium-term consensus earnings estimates. So they're trying to forecast consensus earnings. They're trying to forecast what all the brokers are going to forecast for this company, which is tricky to do. And they do have a target price of $7.22. So let's have a look at the chart for Siteminder. SDR. Siteminder. So this one, not very good technically. In fact, if you have a look at the weekly chart since they listed, the share price has really done nothing. And I think one of the reasons behind that is the valuation is quite high. Market cap of 1.3 billion. Company's not yet profitable. And for me, I need to see that profitability. I do like the growth in the company, but I need to see that profitability. Now on to the last one. And the one I really want to focus on in this video is just Car Group. So, and the reason behind this is because they do mention P ratio, where it is right now. So Car Group is currently trading at a discount to its 5-year average multiple P ratio. This is despite its expectation for mid-teen earnings per share growth over the medium term. So in the quote Mr. Mickleborough has used, Wilson's mentioned here, Car's valuation is attractive at a P ratio or P multiple of 31 times, which represents a slight discount to its 5-year average. So I thought, really? Car Group has a P ratio currently of 31? And then I had a look at we'll have a look at the chart in a second, but we can get P ratios from a few different sites. So TradingView says the P ratio of Car Group is about 50. You can get it from CommSec. CommSec says Car Group's P ratio is, I think, about 40. Have to go to the summary section, about 40. And the other one I'm going to have a look at is, well, I'm already on the page. There you go. In FinChat. And FinChat says Car Group's P ratio is 49, which is fairly similar than TradingView. a little bit higher than CommSec, but significantly higher than Wilson's Asset Management. And that did intrigue me, because if Car Group's P/E ratio actually was 31, this company looks really attractive. So which one's right, 50 or 30? And that is very important. So what I did is I just had a look at the company's most recent financial results. So in fact, I've got the P ratio here. So if you're just looking at P ratio, this company is not attractive right now because it's historically high levels. In fact, very rarely does a P ratio of this company get above 45. There was a period back in 2019, 2021 where the P ratio was between 40 to 45. Prior to 2019, P ratio of this company was actually less than 30. So yeah, if it was 31, this could be attractive. So I just had a look at the company's financials. In particularly, looking at net income, I just want to see if there was a 1 year where the income was significantly high. And it was. In 2023, the income of this company was 645.6 million. In the last year, 250 million. In the last 12 months, 256.4 million. So I sort of can maybe understand how Wilson's Asset Management, in fact, if we break this down into semi-annual increments, yeah, we can see the profit of this company the last, 10 half-year periods. So there must have been a one-off in 2022. And the last 3 half years, the profit of this company has been between 120 and 130 million. So we'll just say the profit in the last 12 months has been $250 million. Okay, so the shares are on issue for this company. And what I'll do is, well, we have a look at the market cap. We don't have to look at the shares on issue. We can just have a look at the market cap, because 250 million, that's a fashion good number. So the market cap, according to Market Index, is 12.6 million. I just want to confirm that at 12.6 million, yeah, in CommSec it's 12.6 million. And we can also look at Trading View, and Trading View says it's 12.7 million. So slight differences between the three. So we'll just assume it's 12.5 million to make my calculations easier. So $12.5 million, $12.5 billion market cap, $250 million profit in the previous 2 half-year periods, which means P ratio of this company 4 times 12.5 equals 50. 50. So I actually am leaning more towards Trading View. Now, I could be completely wrong. And if I am wrong, I'd love to hear about it. So I'm more leaning towards Trading View and FinChat, in that Car Group's real P ratio, based off the last few half-year periods, is actually more like 50, not 30. I'm not sure how Wilson's is getting that P ratio, but if you do go back to FinChat and have a look at the P ratio of this company, you'll notice there's a big drop in P ratio back in 2022, 2023. It actually went down to about 15, in fact 13. So if you're just having a look at the P ratio of this company back then, you'd say, oh, the P ratio of this company is 13. Oh, it's an absolute buy. But again, there was a one-off in that financial year. So that's why profit was high that year. And you have to take that into account. So I'm not sure Wilson's is doing that. So maybe just a possibility here. Considering this car's valuation is attractive at a P ratio of 31 times. That could be forward-looking, and maybe they are very confident of significant growth in Car Group over the next few years, and that could be the forward-looking P ratio. I don't know. Because I don't mention it in this little quote. Anyway, so I'm not sure if I agree with Wilson's when it comes to Car Group. That is attractive when you look at the valuation of this company, or the P ratio of this company right now compared to historical ranges. Okay, so that's all I have for, oh, by the way, the chart. The chart for Car Groups, yeah, it's a nice looking chart. This is actually the chart of a high quality company. Even though share price has pulled back recently, it's a chart of a nice high quality company. So if you have a look at the weekly chart, and I would say this, out of the three, this is the highest quality company because it's got more track record. So if you just have a look at the weekly chart and look at the 200-week moving average, again, this is a beautiful chart. When the share price falls below the 200-week moving average would be a time to buy. And right now the share price is well above it. Well, maybe not well above. It's about 20% higher than the 200-week moving average. So we have seen the share price of this company hit that level or just go below it about 4 times in the past 8 or 9 years. Will it do it again soon? Maybe, maybe. Okay, so that's all I have for this bit of a reaction to this Motley Fool article titled 3 Super ASX 200 Stocks to Buy After Market Sell-Off. Wilson thinks these shares are buys after recent weakness. What do you think about these three companies? I don't mind, particularly Xero and Car Group. Siteminder just needs to become profitable, and then I'll become much more interested in that particular company. Anyway, so leave your thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.